Dr. Babasaheb Ambedkar Open University.
Friends, I welcome you again to our discussion on journal entries or journal, and we will try to understand it in a better manner with the help of some more transactions. These are all practical transactions which take place in almost all types of businesses. The next transaction is Anil Brothers return goods of rupees 1000. These are the transactions of purchase written and sales written. I have recorded two journal entries. There are two transactions taking place. One, Anil Brothers is returning you goods of rupees 1000. So you must have earlier sold. Dinesh Corporation has earlier sold goods to Anil Brothers. Now maybe goods are defective or for any other reason the goods are being written. We may write here. We have given in the information that Anil Brothers return goods of rupees 1000 as the same was defective. So it might happen that we may retain these goods with us and we may sell it to somebody else, maybe at a discounted price because it is defective. Or if we have gotten agreed terms with our supplier, in turn we will return these goods to our supplier because it is defective. And here I have given you a transaction in such a manner that these goods which are written by Anil Brothers, our customer, we have written it to our suppliers. We had purchased these goods from, let's say, Rajesh Traders. So we have written it to Rajesh Traders. Now, to tell you that when you sell the goods, you sell it usually at a margin of profit. And I have given information here that we have returned it to Rajesh Traders for rupees 800. Now, why 800? I might have purchased goods from Rajesh Traders for 800 and I might have sold these goods to Anil Brothers for 1000 rupees. When I get back goods from Anil Brothers and if we have agreed that I will accept the return goods if they are defective, I need to give credit of rupees 1000 to my customer Anil Brothers because I had sold him goods for rupees 1000. But my cost of these goods were 8000. So when I return it to my supplier will not give me credit of rupees 1000. He'll give me credit of rupees 800 only because he had charged me 800 rupees for these very quantity of goods. So how this transaction will be recorded? We are now looking at the journal entries. I have recorded both of them on 25th of November 2014, assuming that the transaction of sales written and purchase written have taken place on the same date, namely 25th of November. For sales written, we are learning the entry first. Sales written account debit 1000 to Anil Brothers account credit 1000. Now why sales written account is debited? Let's understand it. When goods are written by our customer, the goods come in. Goods account we have seen is a real account. For real account, the rule is debit what comes in. So because the goods are coming in, we need to debit it. But we don't write goods account or sales account. We are writing sales written account to distinguish it from sales. Some authors may suggest you that you should debit it to sales account so that your net sales would be reflected in your books of account. But it is always better to debit it to sales written account so that you can distinguish. You will have two separate ledger accounts, one for sales, another for sales written. Naturally, in the final accounts of the business enterprise, you will be showing net sales, but there you will write sales gross this much less sales written and then you are writing net sales. So to have a separate figure about the total sales written, we are opening a separate account called sales written account, which is debited by 1000 and Anil Brothers account is credited by 1000 rupees because Anil Brothers, which is a personal account, is the giver of the goods. He has given you. For personal account, the rule is credit the giver. Anil Brother gives you these goods, returns you these goods. Therefore, Anil Brothers account is credited. Now, let's look at the journal entry relating to purchase written. These very goods of rupees 1000 returned by Anil Brothers, we are returning to our supplier, namely Rajesh Traders. So we are debiting Rajesh Traders account by 800 rupees because the cost of these goods was 800 and Rajesh Traders is going to give us credit only for 800 and not anything more. So Rajesh Traders account is debited by 800 because we are returning goods to Rajesh Traders. Rajesh Traders account is a personal account. For personal account, the rule is debit the receiver, credit the giver. Rajesh Traders is receiver of goods. We are giving him goods. He is a receiver. It is receiver. So therefore, Rajesh Traders account is debited by 800. And we are crediting purchase return account by 800. Purchase return account is also an account relating to goods. And for goods, which is a real account, the rule is debit what comes in, credit what goes out. Here the goods are going out because we are returning goods to our supplier. Therefore, purchase return account is credited, my dear friends, by 800 rupees. And we have written narration being entries for sales return by Anil Brothers and purchase return to Rajesh Traders. Let's look at the next transaction. The transaction is like this. Received payment of rupees 2000 by check from Jayendra Brothers towards commission income. You need to carefully study and understand the transaction before attempting to record these into journal. We are getting these amount of 2000 from Jayendra Brothers, friends. But we are not either debiting or crediting Jayendra Brothers account. Why? Because we are receiving these amount towards commission. Commission is our revenue income. It is our gain. And it is a revenue account or nominal account. Nominal account, the rule is credit all gains and incomes. It is an income we have earned. We might have provided some service to Jayendra Brothers and they might have agreed that if you give us this service or for purchase or sale or anything, you will be given this much commission. So we have got 2000 rupees as commission. It is our income. So commission account is credited. You may also give it a name commission income account. Sometimes you may be giving commission to others. So that is your expense. So to distinguish, if you have got commission expense and commission income, you may, to distinguish expense from income, give it a name commission income account instead of writing just commission account. So commission account is credited, friends. Which account is debited? Dena Bank account is debited by 2000. Why? Because you have got this money in the form of check. When you have got this money in the form of check, you are going to deposit this check into Dena Bank account. So your asset will increase. Your balance with Dena Bank will increase. When asset increases, that asset account is debited. So Dena Bank is your asset. Dena Bank account is debited. Or in other words, Dena Bank account is a personal account. For personal account, the rule is debit the receiver. Dena Bank is now getting this money. We are depositing check into Dena Bank. Therefore, Dena Bank's account is debited by 2000 and commission income account is credited by 2000. Commission is an income. As I told you earlier, any revenue expense or revenue income will have a direct impact on owner's equity or capital. When revenue income is earned by you, it increases owner's equity. Therefore, owner's equity plus means credit. When you get revenue income, your equity or capital increases. Therefore, it will be credited. Even applying that rule, commission account is to be credited. The next transaction is IDBI Bank has debited interest of rupees 200 on term loan on 1/12/2014 for the month of November 2014. Usually these banks are debiting your account in respect of interest every month. Now there is a practice that banks are charging interest monthly. So if you are now charged with an interest of rupees 200, interest is your expense. It is your revenue expense. Revenue expense means it is a nominal account. For nominal account, the rule is debit all expenses. So interest is an expense. It is debited by 200. Interest account debit. You may also write it as interest expense account to distinguish it from interest income, because if you invest money in outside business, you sometimes earn interest. If you give loan to somebody, you earn interest on it. That becomes your interest income. So here interest is your expense because you have to pay interest to IDBI Bank because you have borrowed an amount of rupees 25,000 as term loan. You are enjoying that money, and in reward, in return, what are you giving? You will repay this money to IDBI Bank. You will also pay interest on the money borrowed by you. Here we are recording transaction only relating to interest of rupees 200. Please note, you are not actually paying this interest right now. Had you paid this money an amount of rupees 200, the entry here would have been interest account debit to cash account credit if cash was paid. If it was paid by check, you would have credited it to Dena Bank account. But what has happened is, today the transaction is IDBI Bank has debited your account, your term loan account. So you need to credit IDBI's term loan account. So what we have done is, interest, which is an expense, that account is debited by 200, and term loan account is credited by rupees 200. So term loan account, why it is credited? Number one, it is a liability. Your liability increases because earlier you had to pay only 25,000 towards term loan. Now even you have to pay this 200. Your liability is increased by 200 rupees. When liability is plus or liability increases, that liability account is credited. Term loan account is a liability account, therefore we have credited term loan account, and the journal entry is being recorded with the narration being entry for interest due on term loan for November 2014. So from these narration or the details, you can come to know about for which period is this interest charged. Some authors don't even write being entry for, they just write just entry for. Being is again a traditional practice which most of the authors are following for writing narration in respect of any of the transaction which is recorded in the journal or books of accounts. Let's look at one more transaction of expense. Usually at the end of month you pay salaries, or maybe after the month is over you pay it to your employees. Here is a transaction wherein you are being told that paid by cash rupees 4,000 as salary to accountant Mr. Ram for November 2014. Please note, so far as the account to be debited or credited is concerned, the name of Mr. Ram is redundant. It is of no use to you. You may pay salary to anybody, any Tom, Dick and Harry, X, Y, Z, A, B, C. That name you are not recording because salary is an expense. You may be paying salary to 100 employees. All of them would be debited to salary account, which is your expense. Salary is your revenue expense. Revenue expense is known as your nominal account because we have seen any expense account or loss account is a nominal account. For nominal account, the rule is debit all expenses and losses. Salary is your expense. So debit salary account. Therefore, we have debited salary account. Friends, look, salary account is debited by 4,000. Now you have paid cash. So your cash decreases, or cash account is a real account. Real account rule is debit what comes in, credit what goes out. Your cash goes out because you are paying cash. So cash account is to be credited. Even going by the rule of asset plus asset minus etc., cash is your asset. Your asset decreases here because when you pay money, your cash or asset decreases. So when asset decreases, that asset account is to be credited. Even going by that rule, cash account is to be credited, and therefore we have credited cash account by rupees 4,000. In the narration we have written being entry for salary paid by cash to accountant Mr. Ram for November 2014. The organizations who have got hundreds of employees, they may not even write name of each employee. They may write as per salary register or as per statement, and that statement or salary register will carry details about each and every employee. But while you are recording transaction for salary paid to all your employees, there will be only one entry, salary account debit to cash account credit if you have paid it by cash. Mostly nowadays people are paying salary by account pay check or by direct credit to employees account. If this money was paid through bank, by check or direct credit to the account of the employee instead of cash account, friends, we would have credited Dena Bank account, because if we are paying money from Dena Bank, so Dena Bank account would have been credited, because our balance with Dena Bank would reduce. Our asset with Dena Bank will reduce when we make payment out of our bank account. So you need to learn many more transactions, my dear friends. I have given you some few examples of about 17 transactions in these many parts of our discussion, but study more and more transactions, understand them carefully, and once you have understood one transaction thoroughly, any similar transaction of that nature, you won't face any problem in recording that transaction correctly. Now in these journals, maybe periodically they will be totaled also, but as I told you, because whatever amount you are debiting, that very amount you are crediting, and therefore the totals of the journal would always be equal. Total of the debit side and total of the credit side of journal would always be equal. That I have not shown in these slides, but the people are also totaling the journal periodically, and the total of debit and credit would always be equal. If it is not equal, you might have committed some mistake. You have to check. You might have debited 4,000 and you may have credited just 400. Then there would be mismatch of the total. Otherwise, and then you would be able to realize if you have and find out if any error is committed by you. With this, we conclude our discussion on journal entries, and I repeatedly keep on telling you, please practice more and more transactions out of the study material that is given to you, out of the reference books that you can lay your hands on, and you will empower yourself in terms of knowledge on journal entries. Thank you very much.
Dr. Baba Sahib Ambedkar Open University.